Hi, everyone, and welcome to Fuel Podcast. My name is Alyona, and I'm CEO and co founder of Fuel Finance. And at Fuel Finance, we make finance fun for all founders. And today, our guest will be Joachim, who is co founder and partner of Acrobator Ventures, which is already invested in more than 8 different startups like Respeecher, Let's Enhance, also Miro, also Binarly, and many others. And also, I know, Joachim, that you was a CFO and financial advisor before your investment career. So it will be very interesting to discuss today with you all financial questions from both sides, financial and investment side. So thanks for joining us. And my first question will be the most complicated question and the most interesting question for all startup founders. How do you make valuation of startups? So do you have some formula? How do you do that, or some metrics? So
Mm.
what is important, and how really founders can make valuation of their startups?
Yeah, I think there is no formula at earlier stages. I think the way we approach the value of a startup is, first of all, define with the startup that what they think they need to raise is actually what they need to raise to get to a milestone that allows them to raise the next round. And then look through the dilution over time, from a pre-seed to a seed to a Series A and beyond, to see sort of what's a balanced outcome. So from our side as a fund, we have certain ownership targets that in general would say we need about 10% of a company. But that doesn't always apply depending on what we believe the company should be able to do. But whatever value we put on a company when we invest, it is a value that allows us to make a fund returner on that investment.
Mhm.
And if that doesn't match with what the founders expect or want, then from that point of view, it doesn't work. But we haven't encountered a situation where we were in such far disagreement about that. Because when you look through it from a cap table point of view and ownership and dilution and the reason why we need a certain stake, it's a pretty easy conversation to have. Um, I mean, I believe the rule of thumb is that at Series A, founders should at least a team at least have 50% of the company
Mhm.
beyond Series A. So if a pre-seed you will be faced with an investor that says I want 25% of the company, then probably you'll have a problem when you're raising your Series A. So that's something we try to pay attention to, and that then defines what we pay for a company.
So am I right that like founders should not should have at seed stage no less than 75% of the company? So when
It,
they
it,
like
it,
make a
it,
fundraising?
it depends a little bit what the expectations are, right? But yeah, rule of thumb is every round there's about a 20, 25, 15 to 25% dilution um, in general. But I think it depends case by case.
But do you already have some data, I believe, with other startups? Can you share some average valuation that you see now, for example, on the market? What was it valuation, for example, 1 year ago? What do you see now from your current portfolio companies? What is average for pre-seed or seed stage?
Well, first of all, I think that it's a very tough time right now regarding valuations. And that basically has to do with you know, if the stock market goes down and listed companies in tech space go down, that does trickle down all the way to pre-seed. It doesn't go as fast, but it will. And that's what we've seen happening. So the later series evaluations have dropped drastically because they're closer to stock or an IPO, let's say. And then, Series A came, and now we're actually seeing a slight reliving, I think, of Series A, but a suppression on the seed stage. And this, has to do with this mechanics. If like I can't expect a Series A to be raised times revenue. It's just.
More than three times revenue?
Can you hear me?
Yeah, yeah.
Yes. Sorry, my Siri went on. So
No
I can't
worries.
expect a Series A to be raised at 50 times revenue, which was something that was quite normal in 2020, 2021, right? So I need to assume that the Series A is going to be raised at 10 to 20x maybe.
Hmm.
So,
And what
but,
about seed or pre-seed stage?
well, to us, like, let's define what we understand as pre-seed and what we define as late seed. So pre-seed for us is anything that has virtually zero revenue or very little, where whatever traction there is, you know, growing from 1,000 to 3,000 MRR is an amazing percentage increase, but it doesn't mean anything yet, right? It could be one client difference.
Yeah.
Um, for us, like the traction below 500K is still a very unclear zone, because still there, if you're talking, unless you're talking sort of like B2C with very small contract values, um, it could be a difference of three bigger clients that bring you to 500K ARR. So for us, we don't put a very high value on that. We would then look for other metrics. But in general, you know, we could look at, saying, oh, it's about 10x or 12x or 5x, but honestly we don't. We look at it from the cap table and dilution point of view. Like for us as an investor, it's very simple. Like, we need to need to get a stake in a company that allows us to return our fund. That's the metric.
Mm.
So we, in theory, if you follow that train of thought, we are you know we are not concerned about the value we pay for a company, as long as that value and percentage ownership allows us to hit our target. So we don't really care whether it's 5 or 7 or 8 million that we're paying. Now, obviously, if you are a two-time founder and you've got, an amazing track record in building companies, you can demand a premium on that valuation.
Hmm. And what
That's.
about yeah, what about your you mentioned about several times about return on investment, so on your fund. So
Mhm.
what is your criteria for that? What's your goal? So do you
So,
expect from a startup to make 10x, 50x for like 5 years? So what is
yeah,
this?
let's put it differently. We have a 25 million fund,
Yeah.
which means any investment we do needs to return 25 million,
Hmm.
because
Understand.
not all of them will. Most of them won't. Most of them won't
Yeah.
return anything, or very little. That's the reality. So
Yeah.
yeah, let's say we start with 10% in a company, and through dilution we end up with 5% in the company by the time it exits. Well, there you go. There's your sum. We need 5% of 500 million. So the company needs to be able to generate 500 million. Now, 2 years ago, that was, if you had, let's say, 10 million in revenue, in theory, you could be worth 500. Today, you probably need 50 million in revenue.
Yeah. Different situation now.
Different situation, right? So that's the thing. And of course, there are always exceptions, right? Companies that grow phenomenally well, that have very large markets they can adopt, that have a real moat based on domain expertise that can't be really entrenched on very quickly. They are still able to demand very high premiums. But
Yes.
we never, like, and then you, of course, like, everybody's now, especially I mean, we saw each other last in San Francisco. Like, anything that has the word generative AI, you know, raises money. We are not an investor that chases the next or the current sort of hip thing. Um, we invested in Let's Enhance, way before, and now they're fully on the generative AI side. Of course, Respeecher the same. Like, we're doing
Yes.
synthetic media investment before it really became a hot topic. Um, so we definitely don't go for the fear of missing out valuation types. then we rather, because it just doesn't work, right? Then we
Yeah.
own too little of a company, and then we own 1% of a 500 million company. On paper, we can go great, but in reality, it returns 5 million,
Yeah, but it will be
and
not your
and
goal.
it won't be enough because the chances, and that's the reality, right? The chances of your company selling for something like 500 million is just very low. It's very, very difficult to build, you know, solid companies with high growth potential, high revenue potential. And not every company has to be that. I mean, it's fine to build a company that maybe, ends up generating 10, 15 million in revenue. Just make sure that you get investors on board that understand that, and you understand that, that is okay for the investor.
Yeah.
Angels, for
Yeah.
angels, it's fine, right? They don't need to return 25 million. They just look at the investment itself.
Yeah. That's another situation. But
Yeah.
going back to financial
Mhm.
metrics, what do you check when, for example, when you make analysis of a startups before making an investment? So what metrics are important for you? What do you wait like from startup like to send you like maybe financial plan or P&L statement? So
Mhm.
can you share like what metrics are important for
Yeah,
you?
we always ask for startups to send some kind of model of what they think, how their company operates. And we're not interested actually in the model, we're interested in the assumptions they're making. Because the
Mm,
model will always be right until unless you make mistakes in the model. But the assumptions are more important, right? Because the assumptions are, we expect that by hiring an extra salesperson, we're going to onboard X more clients, and then we can go into a discussion like, how do you know? How real is that? And that gives us a much better understanding of if the founders understand their company. Um, and once we've gone through that discussion, then we look at the financial model, and then we go through it with them on the point of view of like, okay, so if we know that we need to hit this and this metric, whether it's a revenue target or a growth target in number of clients or the velocity of it, what is the capital requirement for the company, and then multiply it by two.
Basic rule multiply by two what a
Yeah,
company
it costs
asks.
twice as much and it takes twice as long.
And what about revenue forecast? So I always like have doubts about this revenue forecast, especially at early stage
Mhm.
of the company. So when you
Yeah.
make this like like predictions like that, growing like very fast
Like,
as
like it's
okay in the future.
yeah, the model is always right. Yeah. So
Yeah.
we have a couple of companies now that are in between 1 and 2.5 million in revenue, where their growth is the pace is so solid that you really can start projecting out, right? They can start saying like, okay, we're going to put two SDRs extra because we have very good indication that we're going to generate X amount of sales because we have already so much data. Most companies aren't there yet. So again, it becomes assumptions like, what do we think, how will that grow? And the most important thing about that model is the first 12 to 18 months until your next milestone, and then constantly looking at it like, how real is it what we thought, are our assumptions valid or not? And that's where tools like Fuel come into play, especially when there's more complexity to it with bigger pipelines and different things. Or you can have very simple tools. You can either do it in Excel or use other tools. But we do look at if the founders have some kind of grasp of understanding finance a little bit, so that they understand the value of um, cash flows, um, because that's where things go wrong. If you can't, to a certain degree, understand what's going to happen in the next 4 months, you can all of a sudden be very surprised about how little cash you have left in the company.
Yeah, that actually was my next question about financial literacy of
Mhm.
founders. How is it important for you? So do founders need to be financial literate, or as you mentioned, they need to have at least some level of like financial
I
understanding?
think, yeah, I think awareness is more important. It- like, I don't need every founder to be a master salesman, right? Right, but they need to be aware that it's necessary to build a great company. So, if they don't have that financial literacy themselves, then I need the awareness that they know, like, okay, this is important. This is see it as a risk in your company, that is one of the risks you can actually influence.
Yeah.
Right? You can't really influence whether your product from a timing point of view is in the right place at the right time. Like, there are market trends that you can't do much about it. You have to get lucky. When it comes to things like operations, finance, um, you know, those are risk, or founder communication, leadership skills. Those are risks in a company which are significant, which you can influence. So my message to founders is, like, see it that way. See it as a risk you want to minimize in an efficient way, so that whatever risk remains in the company is the risk you have to accept, running a company in a startup that is super risky, if it will work or not. But
Yeah.
yeah, finance and stuff shouldn't be one of them.
Interesting. And what about financial mistakes? So I believe that you saw many different financial models and also many different statements. So what are the most popular financial mistakes or the most crucial financial mistakes that founders make?
Mhm.
And how can they avoid these mistakes?
Making models that are way too complex.
Way too complex. So this
Yeah,
is a mistake.
yeah, yeah. Having
What does
these
it mean?
super detailed forecast models with tons and tons of formulas and dependencies, and you know it's it's bound to have mistakes.
That's crazy. And I believe so that this model's made by not founders, but some financial people, maybe, yes.
Correct, yeah, usually, or a combination of. And that's where things go wrong, because you think you have accuracy, you think you are like, oh great, we've got this down to a T, but you don't, because it's not that easy. um, so it's about big rough estimations, core assumptions, that matter, right? Not if by hiring an extra person you need to buy three extra pencils. Who cares? um, so so that's where things go wrong. And I think there are plenty of standard models out there you can download, and stick to those that are tried and true. And you know, I think that's where you know don't spend too much time on it. I've seen horrible mistakes in cash flow prognosis, where founders will go like, "Oh, we need 3 million extra," and it's just because there was a mistake in the formula, that they were literally counting it wrong instead of. They're not costly mistakes, in the sense that it's just a thing they made for fundraising, but it's silly. Um, I think the costly mistakes are if you start trying to build models and do compare actuals versus forecasts. If you start building that yourself, just don't.
That's great. And what about revenue?
Mm.
Because I also saw some mistakes about revenue calculations, for example, accrual basis and cash flow basis. So, and revenue is important for valuation. How about that? So I believe like
Yeah.
maybe early
So,
stage pre-revenue not important, but
yeah.
later.
So for yourself internally, it's cash. Cash is the only thing that matters. Like, ARR is our in principle vanity metrics. You can
Yeah.
have 2 million ARR, but if you have 120-day payment terms, you're still running out of money.
Yeah, that's true.
Yeah. So for yourself internally, and also to make your investors understand your cash needs, just cash basis. And then, but indeed, from a point of view of reporting, to understand like what's going on in the company, over time, then accrual basis makes a lot more sense, because then you're spreading out costs that you might pay in 1 month, but they're actually attributed over the whole year. Or the same for contracts. You've closed 100K contract in March, but the payments go over time. So there, I would say those are the two different things. For yourself, it's cash basis, because that's the only thing that matters. And then for reporting, it's accrual basis. And then, sorry, oh, am I still there? Yeah.
Yeah.
And yeah, and definitely, don't start mixing the two with, you know,
Make some
accruals.
accrual basis
Yeah,
reports.
yeah. Like, I mean, we've seen very strange ways of inflating revenue by putting the two together, and you go like, but that doesn't make any sense whatsoever. So yeah, I think actually one challenge we see with quite some companies is, there are two things I think are important nowadays more than they were before. Like, one is, of course, you know, making sure that you're able to show your growth in ARR to investors. So when you have a pipeline and you're adding new clients, like, how is that building up? Because that's an indication, a metric that investors, especially if it's of course SaaS, you know, the growth in ARR is important, churn, whatever. Um, so that one needs to be very clear. And another one, which is more on the bookkeeping side, but especially if you're in SaaS, um, investors look at gross margins. So SaaS gross margins, at one point they should be around anywhere 80 to 90%. But what we see very often is that the bookkeeping is done wrong. So the way costs are attributed either at cost of goods sold or not, like before or after gross margin, there are quite big mistakes in there. So you'll have companies that show like 99% gross margin, or the other way around, like 25% gross margin. And I think now, especially if you've raised your initial, your pre-seed or even seed, where these things aren't that important yet because the amount of revenues. And but when you go towards Series A, you want to be able to show that you have a company that has a reason for being. And a reason for being is a company that earns enough gross margin that if you would say turn off the accelerator by hiring more people faster than your company actually can afford to, hence you need to raise money, that you're able to have a sustainable company. So that gross margin is incredibly important. So to get that right, and getting it right is, there are basic accounting rules of how you do that. They're pretty standard. Then there are things you have to decide for yourself, because you have a developer that does new features, which is definitely not part of your gross margin, but the maintenance on the current product is. So you have to make these decisions, like X% of development work is part of cost of goods sold, let's say, or before gross margin, the rest below. Just make a memo of that, how you account for it, so that when someone goes to look at your numbers, they understand, like, okay, this is how you calculate your gross margin. They either agree or not, that's fine. But at least, that is then, I think, a very crucial one when you're raising a Series A. We have had companies that or one company that in 2021 was still on track to raise a Series A, but very low gross margins. And the reality hit, of course, that all of a sudden, cash matters and cash flow matters and profit matters like it should. And they weren't able to raise a Series A because the same investors that initially said, like, yeah, growth over everything, gross margins don't matter, when they came to raise with these same investors, they said, well, actually, we want to see at least X% gross margin. And they're right. It's not that, they came back on their word. It's just a reality check again. Like, the cost of capital has gone up again, right? Cost of
Yeah.
capital was zero. So then nothing really mattered. Now it does.
Yeah, that's interesting also, because when we discuss about cost of capital and
Mhm.
all this like discounted cash flows, and that's now like cost of money and other for also for VCs.
Yeah.
Uh, and now cost efficiency is a new trend. So like we all see this that like I don't know 1 2 years ago it was a situation when grow no matter what and spend all your money in it. How about now? And what would you recommend to startup founders during this period and about current cost efficiency? So how do they manage, how they need to manage their finance in this current situation?
So let me first say comment about discounted cash flows. That's a
Yes.
popular valuation metric um, for companies that have predictable cash flows, not for companies that don't. So
Yeah.
discounted cash flow valuations for startups are nonsense because your cash flows aren't predictable.
Yes, it's true.
If that were the case, then yeah, you can demand very high valuation, but you just can't. Um, so um, I think this question depends on who you ask. I think if you're in the Bay Area and you have a startup there, you're sort of forced to throw everything at it to prove that growth. So we have one company that is in there completely, and their burn rate is way higher than the companies that we have with teams in Ukraine or in Armenia. Um, but it's a requirement. Like they need to show very fast that they have traction, and they need to hire the talent to do that. I think in if you have a lower cost base, because basically very highly skilled, very talented people in Armenia and in Ukraine cost less than it would if they would live in the Bay Area, you can afford to have a more of a balanced act where you raise enough to hopefully accelerate really fast, but it won't kill you if you can't raise the next round as fast as you hoped because you're just way more capital efficient. Um, so again, this goes to understanding your cash flows, right? Understanding what is happening in your company, um, and making hard decisions if you need to. Like the company I spoke about that couldn't raise their round, they you know 20 out of 25 people had to leave the company, so they could refocus and rebuild. And that sometimes you have to do that. You have to have that. You have to make decisions fast, not wait.
Yeah, it
Uh,
can be too late.
yeah, because it's too late very quickly, very quickly. Um, so yeah, I think cash efficiency is something to look at. There's an ideal scenario whereby we have two or three companies in our portfolio like that, where they're literally balancing their runway. So they burn as much so that they, given their growth, that they just keep a stable 15 to 20 month runway, which is a great position to be in.
Yeah,
Because
sounds great.
you can experiment, you can say like, okay, we're going to see if we can figure out a way to grow even faster, and if that works, and you understand that you will need to raise a round to sustain that, then you can go ahead and do it. And until you have, you're in this comfortable zone of not having your back against the wall. Um, so that's, especially now, it's harder than ever, I think, in the last few years to raise capital. It is for startups. It is for funds like us. It trickles down, right? So keeping that flexibility is extremely important.
Yeah, but it sounds like these companies that you mentioned that you have from 15 to 20 months of runway and they can balance. So it seems
Mhm.
like they're pretty data driven because when you understand what works, what doesn't work, for example, so you can make these decisions. But if you don't have like data to make this analysis, so it's impossible like to understand what works or what not. So
Yeah, and until you do, then make sure you don't have too many people in the company, right? That's the thing. Like
yeah.
be very frugal with hiring until you think like, okay, I think I understand what is happening here. Before that, be careful.
Yeah, we saw many such cases after fundraising when payroll started like to grow very fast, faster even than like revenue growth or some traction
Mhm.
growth. So yeah, I
Yeah.
believe that's
And
crucial.
look, and there are businesses where that's necessary. We're in a cybersecurity company where, you know, like from day one, their clients are the largest tech companies in the world. So
Hmm.
there is no other way than hiring very talented people to support those clients. And but again, it's an assumption that we all understand. So we understand that that is the business model for that company,
Yeah,
and
you understand this from the
we
start.
agree to it. Yeah.
So yeah, that's another case. And talking about metrics, so you already mentioned about gross margin, about traction, revenue. What other key important metrics to track for early stage startups, do you think?
We're not a B2C investor, not traditionally. I mean, we might do something, but it's not really our thing. So we're not looking at those kind of metrics. Um, so the metrics we look at are also non-financial.
Mm.
So we look at the obvious, if there is revenue, then we look at, the growth, like how fast is revenue growing? Why is it growing? Is it because of the accounts that they have with clients is growing, or are they getting more and more clients? How fast is that velocity of getting, new clients? And we look at pipeline. So how big is the funnel at the top end? How fast do things move through the funnel? What is the attrition? And those metrics say a lot. Like if you have that kind of data already, then obviously you have revenue, or at least you have a pipeline. If you don't have that, then we look at different type of metrics. Then it comes more into the data points of, so one of our cybersecurity companies where we invested together with a US firm, at their pre-seed, so zero revenue, the data points we use to show traction is that they published the vulnerabilities they discovered and then within 2 days, that news was repeated all over the world. So
Hmm.
that's also a form of data points of,
Yeah.
well, there is something there. Um, so I think if you don't have any revenue yet, then when you're talking to investors, try and look at it from that angle. Like, show other forms of metrics, of data points. When we say data points, it's like proof points that show like that you're going in a direction, that there may be something there. Like, we all agree at pre-seed, you don't know if you have product market fit. Like, there is no product market fit. There are indications that perhaps something, could work, and likely won't immediately work, and we'll have to, change and test. But then, anything that goes, whether it's, 100 customer interviews where X% say the same thing, or articles, GitHub star, anything, and the moment you have traction, I think we focus a lot on pipeline,
That,
rather than, you know the number of clients you have today, because in all reality, very often the initial clients are people very well. They become your clients, so it's a relatively easy sell. um, but what's in the pipeline, and how has that been moving through, um, until that it actually becomes a company that you have as a client.
what will be red flags for you, like when you
Not
see company and analyze this company,
if you're
like
not
not
transparent.
analyze them,
Yeah,
yeah,
if you're not transparent.
not
we,
transparent.
we in showing things in so we are extremely transparent as a VC. We will show you how we analyze cap tables through the series to understand what's happening with you. We'll tell you why we need certain things. We'll show you. We expect the same from founders. We expect, that we build a trust-based relationship where also the things that you have doubts about, that you're not sure about, are discussed. So the moment a founder says, "Yeah, we don't actually have any problems," I have problems. Like I have tons of problems in my VC that I need to figure out and understand, and how to deal with our investors, or how to do our reporting better, more efficient, quicker, spend less time on it. Team issues that we need to solve. There are tons of problems always. So for us, red flags are if we get a sense that we can't, really get through to what's really going on. If there's a lack of transparency, um, then we say no. Another reason for us to say no is if a founder says, "Well, sorry, you have a week to decide." Then we just don't do it. I
Hmm.
mean, because it's very unlikely that we understand the space so well and know the founder and the team so well that we're able to make a decision within a week. Like we try to, and we tell people we talk to, or founders we talk to all the time, like get in touch with the founders we've invested in, and yeah, we take our time with the founders to figure out what's going on, understand their business. We do, when we can, we do tons of, whether it's introduction. So we do validation calls on our side to understand like the market that the founder is in, like how it works. And if we think that, the people we talk to validate the business are maybe useful to the founders, we'll introduce them even before we do an investment, because to us that's another validation, and for the founder it can be useful because it's usually an industry expert that might have something to say. um, so we need that time. So a red flag for us is if there is no time.
Hmm. What another question will be about when I checked before this podcast, I checked your LinkedIn and saw that you was a CFO also. So,
Mhm.
what has changed for you from that period of time when you was a CFO? How did you analyze like different metrics? How did you analyze like company health, financial health? What has changed today for you now being already in the role of investor?
Yeah. So I think the point of complexity is, the exact mistake I made, trying to make things so that they are as real as possible. um, it just makes things very difficult. Like it was a big lesson. Like we were like, where the company I was a CFO was a factory actually. So we built a biofuel production facility with a trading organization, and I was way too young to do it. But anyway, the at one point we got a very senior, sort of, I wouldn't call him plant manager, but someone that comes into industrial companies when they're not doing too well, and he goes on to analyze, understand what's going on. Literally, he would go into the meetings, and all he had was just a paper, book and a bag of crayons and a ruler, and just started drawing sort of simple diagrams with, okay, so what's production number now and what is it, and then just every time we had a meeting, put another bar, and then so like, hey, why is this going down, what's going on. He kept it really really simple, trying to get to the essence and focus on the essence, and that's it. So in startups, until they become fairly large, for every function in the company, things should be kept as simple as they can, whether it's finance, whether it's HR, because things need to be flexible and they just need to focus on the core things. So that has definitely changed, from our side as well. Like I have a massively complex fund model, but I struggle to use it efficiently. Like I didn't build it myself. There's a company called Foresight that publishes those. But the one that we end up using more often is just very simple. Like, what did we invest? What do we think our expectation is? When do we think the company needs more money? And our big cash flow prognosis, right? Right. That's what we spend in companies. But
That's
it is like, and that's why I say, like, sometimes these models have a function, and one of the functions is that I can show my investors, like, we do have a very complex model that tries to mimic cash flows of the fund based on our strategy over time. Um, but from a day-to-day operation, it needs to be simple, because these very complex things, like, yeah, they lack flexibility. Yeah.
Yes, it's true. I can say the same because when I was also CFO, I made number of different very complicated models, and now I also use like very simple ones. So we have different dashboards and metrics, but I'm just trying to focus on very like several metrics which I want to track, and I check them very often. But actually, they're the most important, so I don't want to check anything
Yeah,
else.
but you do need understanding of your company, that those are indeed
Yes.
the metrics to track. So that's where, that's
Yeah.
why our discussion around assumptions is for us more important than the model, because it's the assumptions that let us better understand what may be important in the company, but also shows whether or not the founders understand it themselves.
Yeah. Yeah, the most complex model they make usually on the stage, and the less they understand about their business model. So this is actually the secret. So I also saw these complicated models when founders just bought, like some models in internet, and they like had the question, okay, what we should do with that? I don't understand. What is this model about? So yeah, that's crazy. And last, my question, what will be your top three financial management or like any management recommendations for startups?
Are we talking tools or?
No, no, just like, like what mistakes to avoid, or just top three recommendations, like for early stage, for pre-seed, seed stage startups, or
Mhm.
a a round startups. What will be your three top recommendations?
Yeah, I think let's skip the A round, because I think from there on there's much more to do. But let's call it below 1 million in ARR, right?
Okay.
I think there, and especially below the few hundreds ARR, like, be on top of cash. That's the most important. So just I mean, at the very least, just know what your bank balance is every day, and what goes in and what goes out in big chunks. And then, once you have that, start drilling down from there. Either because you track it yourself, you're using a tool, you're using something like Fuel. But you know, that is just be on top of cash, and try to get to a point as quickly as possible where you understand, okay, these are the big drivers of making or losing money. um, when it comes to marketing dollars, like, make sure that when you're spending money on marketing, you understand what it does bottom line, or gross profit, because I've seen companies go bust literally because they thought they were growing great, but actually every dollar they got extra in revenue cost them 1.6 or 1.16, sorry. And they just didn't have that insight, because they had too much complexity around it. They had these massively complex models and everything, but they just couldn't connect the dots. um, and that is a shame, because you think you're doing well because you're growing fast, but you're just digging a hole.
But actually not.
But actually you're not. Yeah. So I think that's very important. And make sure that especially your co-founders are in the loop. Like, very often, like, if you have a couple of co-founders, only one really looks at finance, the rest doesn't. Make sure everybody understands, and let and once you have these big metrics that you're following, make them understandable also for the other people in their company, that they understand that how they contribute to it.
That's very valuable. I think it's like the best case when everyone understands what impact they create.
Everybody should have a level of responsibility to make decisions, but in order to make decisions, you have to understand the impact. You have to understand what's happening when you do. So, yeah. think that is important to share as well.
Thank you so much, Joachim, for this conversation. It was full of different insights. I hope that founders can avoid many mistakes after that. Thank you so much.
Thanks, Alyona. Bye bye.